Hey guys, this is Andrew for Trendlines.com. So for those who don't know me yet, let me quickly introduce myself. I've been working as a professional trader for the past 6 years in Hong Kong, and right now I'm doing YouTube videos where I want to show you guys how to use technical analysis to set up the trades and build up your different scenarios. So in this video, I want to make an update on AMC and show you how to use divergences, moving averages, and MACD to actually choose between the different scenarios that you have built using ELLIOTT wave principle. Let's get into it. Alright guys, I've published, I think in the same time, a video where I show you the different scenarios that I build up using ELLIOTT wave principle. So I'm not going to do this again here. Go watch this video so you can see the 2 or 3 different scenarios that I have. And in this video, I want to show you how to actually pick up the most likely scenario that we're going to call our preferred scenario. Very quickly, my different scenarios were either WXY, which is ABC, ABC, ABC. That is finished here. And then we're doing a 1, 2, 3, 4, 5. That is one scenario. The second scenario is that actually the WXY is going lower to 750, and then we're gonna have this same 1, 2, 3, 4, 5, but starting here. So to choose between the short-term bearish scenario and short-term bullish scenario, because in the long term this is bullish anyway, we are gonna use first the moving averages. Very quickly, just for those who want to know more about ELLIOTT wave principle, just click on the link in the description of the video and you're gonna receive a free video where I explain everything about this theory. Now I go back to the moving averages, which I really like to use. So once again, the first thing you need to do, guys, like I always say, you go from one time frame to the other one and you see what is working the best. So for example, on the 4 hours time frame, that is the best time frame for me to use. You know, every trader would tell you different things, but you know, from my experience, and like I said, I've been doing this for quite a long time, I see the best reactions on the 4 hours time frame, and the 200 period moving average is for me the golden one. Is the one, you know, that's why I put it in yellow. It's the one that I think is the most important one. And here, guys, let's do it together. What do you see? If you analyze the chart and you see this, what can you tell? All right, simple. You can see that the 200 period moving average is acting perfectly, guys, as support in the most recent past. Once again, guys, we are trying to analyze what is happening here. And to do that, we actually check if there were nice reactions in the past. Like if I go really back in time, I don't see any very nice reactions, but it's enough for me to see that I have those 1, 2, 3, 4, 5 reactions on the 4 hours time frame in the very recent past, and we are trading above. We are also trading above the 20 period moving average, but you can see that the signals are a bit messy, you know, so it's almost like you don't need this one, but maybe one day you would need it. So always keep this on your charts. Then you change the time frame, you go on a daily, and on the daily time frame, guys, what do we see? Same thing. The 200 period moving average is very far away, so it's not going to bring us any indication here. But we're having the 50 period moving average that is acting as support a bit the same way. So basically, it's like the same information that we already had on the 4 hours time frame. So once again, that's why the 4 hours time frame is the best. As you could see, the reactions were cleaner and we're having, you know, shorter candles. So it's better to, like, you know, identify a breakout because it goes faster. So moving averages are just telling us, guys, we are bullish because we're trading above. So this is not enough to conclude. This is one information. Second information I want to show you guys is divergences. So I've shown you guys this before in my videos. So very quickly, you have 2 types of divergence. You have the regular divergence and the hidden divergence. So the regular divergence, price action in blue, indicator in red. All right. So I use the MACD. You can use RSI or stochastic. So a regular divergence is, let's do the bullish case, when the price action is going lower, but the momentum indicator is going higher, which is showing that the market is out of steam, that the bears are losing control because the momentum is shifting direction. The momentum is going higher. Regular divergence. The one I showed you guys last week was a hidden divergence. Is the market is making higher lows, all right, from here to here, the market is going higher, but the indicator is going lower. What does it mean? It means that there is a very strong bearish momentum, as you can see with the MACD that is, drifting lower, but somehow the price action is going higher. So the bulls were strong enough to actually hold the price above this first low and to make higher low. So this is a hidden divergence. Let's go back to the chart right now. Let me show you very quickly the hidden divergence that I showed you guys already. On the daily time frame, market making higher lows from here to here. What is the MACD doing? The MACD is going lower from here to here, all right, from 0.2 to minus 0.2. So this is a hidden divergence. So on a daily time frame, it all depends on which time frame you're looking for. We are bullish, so it means that probably we're gonna make a new high and then we're gonna make a higher low again. We are in this type of situation. So this is basically something that I knew already, is that we're gonna have a 1, 2, and then a 3, all right? This is the only information that it's giving me. So it's information I had already, but it's confirming that my 1, 2 is gonna be followed probably by a 3. Then we go on a shorter time frame because the answer we are looking for is on the shorter term. We know we are bullish on the long term. What we don't know is if we are going to 750 before bouncing back. So to do that, you need to look for and to find divergences, if there are some, on the shorter term. Let's do it together, guys. We are looking for a market that is out of steam, for a market that is reverting. So where is the bearish trend? The bearish trend is here, guys, all right? So let me get rid of those, all right? You can see that we're going lower, and you can see, guys, that my signals are actually kind of early signals because I showed you guys this trend line that broken on the 15th of April, all right? So on the 15th of April, okay, we wait for a second signal. At 12 a.m., I was turning bullish on the short term. So this is, of course, one more reason that I think, we're probably going to make a 1, 2, 3 right away and that we won't be going to 750, but I need to consider every cases to be professional. So here, the price action is going lower. I'm showing you guys how to find divergences. So let's connect the lows and then we check the MACD. 24, 25th, so it's here. 13th of April. Oh, interesting. What do we have, guys? We are having a regular divergence. The price action is making lower lows, so it's bearish, but the momentum indicator given here by the MACD is actually going higher. So this is a regular divergence that we found on the short term, on the 4 hours time frame. So I have one long-term divergence, hidden divergence, and one short-term regular divergence. Let's see on the 1 hour time frame. I haven't done this yet. If we get anything from the price action here. So very quickly, I see that we have nothing because higher lows and higher lows as well. So no divergence, lower highs, lower MACD. So no divergence, which doesn't mean that we won't shift momentum, but we don't see this indication. So what is the very short-term momentum? Guys, just look at the MACD, all right? The MACD is green, the signal is green, and the MACD is mostly trading in positive territory. So on the hourly time frame, for now, we are bullish and we don't have any divergence. So we don't have any sign of momentum shift. So all this information for now are going into the same direction, is that we won't be going to 750. We will do the third wave right now, very soon. So one more thing I want to show you, and then I'm done, is the MACD itself. Let me remind you guys what is the MACD. So the MACD is the difference between two exponential moving averages, the 12-day top period, it can be day, 4 hours, whatever, 12th period exponential moving average minus the 26th period exponential moving average. So this is the MACD. So it's a difference of exponential moving averages, and the MACD, then you smooth it using the 9-day exponential moving average of the MACD itself. So then you obtain the orange line that is here, and then you compute the difference of those two, and this is giving you the MACD signal. And look, guys, what is the MACD signal for now? So the signal is giving by a change of sign, when it's green and it goes to red. So for example, we had a MACD signal here, right? So here the MACD signal turned red and told you guys that we are bearish. All right. What I'm interested in is when is the MACD going to turn green? Because I can tell you guys that there are a lot of big money investors like asset managers or institutional clients that are using the MACD just blindly on the daily time frame. They use it on the daily time frame. I know about it. I have some friends that work in this kind of companies, and they're telling me that they keep an eye on the MACD. Of course, they're not only using this. Those guys are using a lot of fundamental analysis. But on top of the fundamental analysis, when they want to find an entry point, you know, when, for example, they want to buy AMC, but they don't know when, they're gonna just wait for the MACD to turn green, and the day it's turning green, they're gonna buy. I'm gonna show you guys, for example, here, what happened. So 23rd of Feb, we turn green, so here, and then right away, guys, the next day, we're having a very strong move up. Then it got rejected, fair enough, but then we kept moving higher, and this lasts for, you know, around 2-3 weeks. So this is the usual period of time for AMC. The cycle we're having right now, it can be, you know, 2 months, it can be anything, but right now what we're having on AMC is around 3 weeks. And guys, we are almost complete here. If I consider this cycle would last the same period of time than the cycle before, we are almost done. And if the price action just remains around this level, you know, so it could get strongly sold tomorrow, then the MACD would, you know, keep turning red. It's possible, all right? This is possible. But if we just remain around this level or make a new high, then the MACD is going to turn green, and we're going to have this massive buying liquidity that is coming in the game, and that is going to help us push the price action higher. And once again, guys, let me remind you what I told you when I did my different cases, guys. I was telling you that here, if we go above 1120, we cannot have an ABC like this, because the B wave cannot go above the beginning of the A wave. And if we actually go closer to this 1120, guys, the MACD is going to turn green. So, you know, this is the kind of association that you guys can make. You know, you can suppose that if the price action comes close to the 11 area, the MACD is going to turn green. And we're going to have, of course, this kind of rejection, as we always do when we close to some resistance levels, but probably going to blow it right away. And we are going to do this third wave that I'm expecting coming very soon. So guys, that's it for me. I hope you enjoyed this video, and if you did, please don't forget to click on the sub, like, and bell button, so you're gonna be the first to know when I upload anything new. And stay close to shore. I see you guys.